Hi, good evening. Welcome everyone to UOBK Hian CIO Series webinar number 34. Today we're very honored to have Chris Watling of Longview Economics to talk to us about the Iran situation and implications to world economy and the markets. Chris, you there?
I'm here. Thank you,
Hi.
G. Thank you for having me on. Appreciate it. It's good to be
Yes.
on.
Well, great to talk to you again. Before I turn it over to Chris, a standard disclaimer about today's event. I'm sure many of you have seen this before. And just a gentle reminder that UOBK here offers a full suite of now bilingual research for private wealth clients. And here's a full list of the reports that we offer. In both English and Chinese. I just want to highlight one report we wrote this week on the China Biweekly Outlook, where we highlighted the implications of the new DeepSeek V4 to global semiconductor supply chain. I'm not sure you guys remember in 2025, when DeepSeek was first launched, it caused a bit of chaos in NVIDIA shares when it was down 16% that day because people worried that the Chinese model may decouple from US semiconductors. Now, 1 year later, it is happening. And please read our report to understand what are the implications to both Chinese and US semiconductor companies, as well as the supply chain. Also, we have a number of important reports came out last few weeks, including our CIO quarterly review, just to provide transparency and accountability. We review our views and recommendations on a regular basis. And yesterday, we just had a Chinese language webinar. I'm sorry, Chris, you couldn't participate because I don't think you speak Chinese, but maybe one day with AI, we could make that happen. We talk about how to deal with the rest of 2026, given that so much has happened already. And one of the key points relates to how Trump is changing the dynamics of the whole financial markets from oil to stocks to bonds. And it requires us to take a more of a longer term view now on things and also to have higher conviction even into the investments that we make. And with that, let me turn to our guest speaker. For those who follow us religiously, I should probably know Chris already. He's an experienced macro researcher and a deep thinker. And in fact, he was very kind to participate in our last CIO series in January 2025. Chris, I'm not sure you remember, that was your first partnership with us. And what's most impressive about him that he correctly called the European stock market rally more than a year ago when everyone was worried about Trump's tariffs. And that was a good call, Chris.
Thank you. Yeah. It's good to get some things right.
And today we're going to talk a number of topics ranging from the US to the Middle East to China to Europe. And if you want to dial into the previous webinar, that's the replay link on our YouTube Wealth Vision channel. And with that, let me turn to Chris. Chris, maybe you can share screen.
Yes.
And I see you.
Yep.
Yeah, I guess my first question, and I know this is not easy to answer because of how fluid the situation is, and I will not be surprised we talk about this today and tomorrow might be a completely different picture, is about the US-Iran conflict. So I want to get your opinion about where we are going with this and what's the end game and how long that this will last, that kind of things.
What a great question. Yeah. Well, it's a great. I mean, it's interesting as well because I was in I was in New York last week and Boston, and attended a large dinner of investors in New York, about 25, 30 investors. In fact, 2 or 3 years ago, we had Scott Besant as the guy being on at that dinner. So it's a great dinner. Yeah, it's a great dinner. I turn up as the sort of the foreigner, the Brit, to sort of add a bit of overseas flavor.
Did you get any tips from Scott Besant?
Well, that year there was quite a political sort of debate between him and one other who was a high-profile Democrat macro guy. So it was quite fun. But anyway, this year it was all about oil. It was all about Iran. The first sort of 3/4 of an hour. I had another dinner in London last night with about 12 investors. Again, it was all about Iran. And I think what you conclude from all that is, no one really knows what the intentions of the Iranians are. We know what Trump thinks. He wants to get out. He's kind of done. He wants to get out, save face. He's worried about gasoline prices. He's worried about the midterms and all that sort of stuff. But no one really knows what the Iranian view is. And I think that's the conundrum. And there's a lot of different opinions in there. And I think the best way to think about it is, what are the prices telling us? Which is why we put all these prices on the screen. There you've got the wholesale gasoline price in the US. Of course, at the pump, it's higher. That's the wholesale price before it gets to the retailer. But you can see it started making a new high. Yeah. And then you've got your Brent futures prices on the top right. And I think particularly looking at the 6-month and 12-month Brent is very interesting. Because it's been edging higher again in the last few days. So these things make us nervous. Our central case, though, is we're going to find a solution here. Somehow Trump is going to find a solution. There's a very good article in the Wall Street Journal today. There was 2 articles. There was one, Trump saying dig in for a long time. We might be there for a while. But then there was also an article about how damaged the Iranian economy is. Inflation in Iran's running at 67% in April, year on year. They've lost 2 million jobs in the last 6 weeks, and a lot of businesses are shutting. So, if you remember the Arab Spring, back in 2010,
that was when 2017 or
2010.
Sorry, 2010.
Yeah, I mean, I had to look it up as well. 2010, 2011. You remember it started in Tunisia when the guy set himself on fire. Do you remember that?
Yes, it was a street vendor.
That's right. Fruit vendor, exactly. And it was all about the price of food.
Yes.
So I think this is the interesting point about Iran. Got high inflation, struggling to get deliveries to Iran now, nothing coming through the Straits of Hormuz. And now they've got internal pressure that must be building quite dramatically. So it's very difficult to know what the Iranian intentions are, but they've got to deal with a population that's going to be increasingly upset and going to want a conclusion to this war. And I know it's an authoritarian regime, but still, so was Tunisia and the rest of them in North Africa. So I think
you expect the regime could collapse any moment, which will probably lead to some kind of resolution to the situation?
Well, that's possible, or perhaps more likely the regime says, well, we probably need to negotiate a settlement for a couple of years, back off, regroup for 2 years, and then if they maybe go again against America. But I think the pressure internally must be building with 67% inflation.
Yes.
And my question in my mind is, what brings the Iranian to the table? Because they don't want to give up their nuclear capability. They obviously like controlling the Strait of Hormuz, and it's an important card for them. So what brings them to the table? What forces them to the table? And I think it's potentially the internal unrest that must be brewing, and the expensive prices and inflation that creates a lot of internal problems for them. So that's the sort of question everyone's wrestling with in New York, in London, across the globe. And I think that's the really challenging issue, because of course, if the Straits of Hormuz remain closed, and I know we're going to come on to this, it creates a real challenge out there for the global economy.
Yeah, I kind of know where you're coming from, and that's probably the reason that market's still reasonably optimistic about the outcome because, you know, by some calls that Iranian will be forced to come to the table and negotiate the peace deal. But generally speaking, how long you think this will, I mean, generally speaking, what's your sense or what's the consensus among the people you speak to? Like, would this end
Well,
in a month or 3 months? Because it does make a difference. If oil price stay above $100 for 3 months versus oil price stay above $100 for 1 month, I think the impact to the economy might be different, right?
yeah, it is. I think once you were quite right, once you get to that 3 month mark, it starts to become more damaging. If it's a month or two, you can almost kind of get away with it.
Yeah.
Yeah, I mean, there are a lot of geopolitical types in New York I was talking to last week, and the rumor is that the staffers in Congress and the chat in the White House is, Trump has to be done by the end of June, ideally by May. But it
Mm.
can't go beyond that because of the midterms in November. He needs to start talking about domestic issues. This is the chat last week that his chief of staff said to him it has to be finished by June, because they're already up against it. As you know, they're going to lose the House of Representatives. No two ways about it. No one expects them to keep that. They should keep control of the Senate, but that is where the real risk lies. And of course, the more the gasoline price is up and the more Iran is happening, the more the risk of the Senate going as well.
Yeah.
So that's the sort of equation. And so I think we might be done in a month or so, but I have to say you can't have a lot of confidence in that because as I know, we don't know what the Iranians are going to do exactly. This
Yeah,
is the challenge.
it is.
Trump would stop tomorrow if he could.
And it's not like Iranian is that transparent. We actually don't know what's going on with it. There's no news reporting, there's no transparency into how really the
No,
country is doing at this point,
no
right?
one exactly. No one even really knows who the negotiating team is. I mean, we
Oh,
hear about the Iranian foreign minister. Partly is it the IRGC probably that are running the show, but no one really, there's not a strong sense of exactly what's going on. So it's very difficult to gauge. And also, if you look at, the Iranian philosophy, they are, Khomeini, before he died, he talked about the great Satan of America. It was
mhm.
death to America. There was a real, a real desire to uh, remove Israel, and so on. So we don't really know what their game plan is.
Yeah.
We know how they use their proxies, Hamas, Hezbollah, the Houthis. We don't know exactly how the Iranians themselves will engage, and whether they want to run an insurgency, because it is an asymmetric war in that America has all the firepower, but Iran only needs to blow one ship up with one bomb, and it keeps the straits closed. So it's a very difficult one to have a strong sense of. That's why I think watching prices is the best way to do it. And
Mm.
I frankly, I don't have a lot of confidence in anyone who says they're an expert on Iran,
Yeah.
because we know what geopolitical experts are like. They're interesting, but it's a very difficult situation to gauge, and really no one's in the know except the people in charge in Iran. So that is the challenge, because of course it's so important to markets. But our central case at the moment is that Trump's going to somehow pull it off, and in a month or two we'll find this thing's concluded to a degree, or at least for a year or two, and the straits will start reopening again.
Got it. And then, well, even Trump himself is difficult enough to understand. I do not expect to understand the Iranian leadership right now. Okay, let's switch gear a bit. You talk about the potential or possible economic pressure on Iran right now. You said you were just in the US. Are you seeing any, well, political pressure aside, I know that Trump need to resolve this for the midterm. Uh, Do you get a sense that the US economy is negatively affected or will be negatively affected by this oil shock? I mean, we talk about the skyrocketing gasoline prices, and typically people associate that with consumer confidence issues and consumption.
Yeah, I mean, there's definitely issues. I think there needs to be perspective though, because there's a lot of forces at work in the US. There's obviously the AI force, which is very positive and largely indifferent to the energy price. I think it has a momentum of its own,
Yeah.
and is generating a lot of profits and keeping the stock market up. And then, of course, on the flip side, you've got all the challenge of higher gasoline prices, the affordability crisis, and so on. So that's why I think it's quite interesting to think about America in kind of two consumers, the wealthy consumers and the lower income consumers, because if you're wealthy, you really don't care what the gasoline price is. It's not relevant.
Mm.
But of course, if you're lower income, it's an awful lot of your income. I did this, so the basics, eat up a lot of income at the lower end of the income scale. So if you look at America and you divide it into the income deciles, the top 10%, the second 10%, and the third 10% account for about 60+% of the total income. And
Mm.
the bottom three income deciles account for 10%. So,
Wow.
so really, there's a massive skew, and the bottom 10% who care about gasoline prices, yes, they're affecting consumer confidence. If you look at Michigan, confidence is at record lows since the 1970s, all that
Mm.
kind of stuff. But it doesn't drive the economy. It's not the main driver. The main driver is the top 3, 4 income deciles, 60, 80% of income, who depend heavily on the wealth effect and the stock market going up, which is why I mentioned AI, because it's propelling the US stock market higher with its profits. So these trends are really important.
Yeah.
But
Well, the market's been
and
doing
we
well since Trump took office.
it's been doing well. It's had a couple of shocks
Despite
from
all the
Trump. Yeah,
despite all the black swan risks. We remember we had the tariffs a year ago, and we have a number of other things happened since then that had disrupted the markets, but the market's still at all-time high.
it's an all-time high. It's pretty amazing.
It
And of
is.
course, if you look at the what's been driving it in the last few weeks, it's absolutely tech. And if you look at where earnings have been revised upwards, that's the tech sector as well. So it's quite interesting. So tech, if you go back to the summer of last year, and I think we talked about this at the time, in the
Mm.
summer of last year, every man and his dog owned Nvidia. You'll remember it was,
Yeah.
it was literally everywhere in the world. People owned Nvidia, and of course, Nvidia topped around October. It had a high, I think, and it's really gone sideways for 6 months. So you've
Mm.
unwound some of that over ownership. It's become cheaper. The IT sector's derated, and now it's back in favor. So, Mythos is back in the game. It's getting everyone excited about AI. So yeah, so the stock market is critical to the US consumption story and the US GDP story, as is AI profitability to drive capex in the US. And of course, we're in
Yeah.
a capex driven US economy. So to give you the numbers, to get a recession in the US,
Mm.
you've got to have an oil price that really is this is our sort of way of thinking about it. You've got to have an oil price that's really around 170 to $200 in the US. It's lower in other parts of the world, but of course
Yes.
the US exports a lot of oil, so that helps. It's got a very strong corporate sector. It's not very oil intensive. So, it's 21 million barrels per day usage in America of oil and oil products. It was 21 million barrels 21 years ago. So the economy's grown, but the usage of oil hasn't.
Mm.
So, it's a lot less oil intensive than the 1970s, and business cash flow is very good. So there are risks, but you need a much higher oil price to cause a US recession. As I said, I think it's not as good in other parts of the world, but that's certainly the case. So yeah, I mean that's
Oh,
how we
US is
sort of.
benefiting. Yeah, we talk about the manufacturing and maybe the exports in a second, but do you think that this oil shock will cause any inflation in the US? Well, we have the gasoline, but don't forget there's also the push up, what do you call it, push through inflation risk that may cause other goods and services to
Yeah,
rise.
so yeah, that's the second round effects as they call them, and the central bankers talk about them. The idea that it's not just a sort of mechanical oil price up, inflation up. It feeds into other stuff. And really, it's going to happen. Urea prices, fertilizer prices are going to go up. Food prices are going to go up. You're going to get a lot of first round effects, but I'm not so sure you'll get as many second round effects. So yes, you'll get a hump. Maybe headline goes to 3.5 for a bit. Maybe it gets to 4. Probably not, but you'll get a hump on CPI. But I don't think it's going to infect wages because, excuse me, if you look at the labor market, there's a lot of spare capacity built up. AI is displacing labor. There's no two ways about it.
Yeah.
And
Reducing
so
cost.
reducing costs, as we were talking beforehand. I mean, so and productivity in the US is accelerating, and the full effect of AI is not there yet, and productivity is already above average in the US and been accelerating for the last 18, 24 months. So this is very encouraging, a very good underpinnings for the economy. So I think the bigger risk is the central bank makes a mistake and raises when it doesn't need to raise rates. Now, I think that is less likely in the US. It's more likely in Europe and the UK and Canada and places like that. Less likely in the US, where you're going to get Kevin Warsh coming in, in the next month or two. He looks like he's going to pass his nomination. The case against Jerome Powell, they've taken off, and so I think Walsh will come in. He's inclined to, I call it, he's channeling his inner Greenspan from the late 1990s. When, of course, Greenspan was going for the productivity miracle, and I think that's what Walsh wants to do. So I think they'll look through first round effects and assume that you don't get second round effects, which I think is correct. So
just relate to what you said. What do you think the Fed is going to say tomorrow when they finish the FOMC this week?
Yeah, and
kind of the same thing you
Powell's,
said.
Powell's last meeting, isn't it? Well, I think. They're not going to change, and I think they'll leave it ambiguous because he's not going to be in charge, and they'll probably talk about risk of second round effects, but they'll also talk about a softer labor market. So that, you remember last meeting they talked about two-way risks from the Fed, so I think that kind of stuff. There's no dot plots this time, so we don't have that to contend with. And I'm pretty sure it's Powell's last meeting, probably.
Yes.
Depends on confirmation, doesn't it? Yeah. So he should leave it open. He shouldn't pre-commit to anything because he won't be in charge to see it through. And I think watch for the balance of risks comments. I think that's the theme. Balance of risk both ways, two-way risks, which is how the Fed's been talking recently.
Well, to me, then becomes a non-event tomorrow. What we should really be watching is when the new chairman comes in, what next step should be. But we keep on our radar screen. That's a very helpful insight about the Fed moves. And before we switch gear to the non-US, I do want to talk to you about. I read your research. You do have a very interesting and non-consensus call on US industrials. We talk about AI, everybody loves AI, and you talk about how that's creating a tremendous amount of profits and driving up the stock market. But what is the story with the non-AI US manufacturing industrial sector?
Yes,
that you
absolutely. Absolutely. And the story is this story about a broadening US recovery. So you remember there was a big tightening from the Fed in 2022.
Yes.
The industrial production was flat for 3 years. You'll remember, you can see it in ISM in the top right-hand chart. The ISM, I put a little green box around it, was below 50 for 3 years for every month except one. But as we get into last year, the Fed starts cutting rates, and you start to get a credit cycle. You can see it with the bank credit here, bank credit growth accelerating. And now we're starting to get ISM manufacturing break above 50 in the last few months. And we'll get another data point on Friday. And the regional surveys, which have already come out this month, suggest that the ISM main survey on Friday will be good as well. So we'll probably continue breaking to the upside, and there's a really strong correlation between ISM and a lot of the cyclical industrial cyclicals. They tend to do very well when ISM is trending up, from 50 to 60 to 65. Now, I must be clear because when I talk about industrial cyclicals, it covers things like transportation stocks, chemical stocks, railroads, and of course the classic industrials. But the classic industrials are actually one sector that's already very expensive in the US and in most of the world. So, and in fact, the forward PE ratio on the US industrials, I think, is about 25, 26, 27 times. And the premium relative to the market in the US of industrials is at a record high. So I'd be very cautious on the pure industrials because I think they all got caught up with AI themes, electricity, and all the data center stuff. I'd be more inclined to look at sort of non-industrial cyclicals, as I said, like transportation stocks. If you look at the railroads, of course, when the industrial cycle picks up, the activity in the economy picks up, the railroad volumes pick up. They look like they're trying to break to the upside. If you look at the transportation sector, it's gone sideways for 3 years, and now it's breaking aggressively to the upside. So I think this stuff is kind of really interesting on a sort of medium-term view.
Warren Buffett loves railroads. I know.
Does he? Does he? Yeah.
Yeah, it's a very stable and strong cash flow business. Steady returns.
Yeah.
And if there's any, like you said, cyclical change, it might be the upside.
Yeah, I would have thought so, and it should be a very good environment for them. It's also good for banks if you get this broadening recovery and you get a steepening yield curve, assuming there's a resolution in the war. The banks
Are you
have been doing very
that
well.
everything described about the U.S. manufacturing and transportation and the industrials has anything to do with Trump's policy? Because what we heard so far, maybe the media is biased. The media keep telling us that Trump's industrial policy is a failure. But the data seem to suggest that there is a cyclical upturn in that sector.
Mm-hmm. Well, I think there's a few
Is
things
that the
going
reason
on.
that maybe the media has not given the president enough credit for reviving U.S. manufacturing?
Well, I mean, there's something in that. I'm not the biggest fan of what he's done, but clearly there's some onshoring, isn't there?
Yeah.
And he's got a lot of overseas countries to invest money in the US. Now,
Yeah.
I mean, who knows how much of that money's actually turned up? There's that, but it's also, when you cut interest rates, you tend to get an industrial upswing. It's kind of all part of the normal behavior of the economy. And then if you look at the hyperscalers, they're increasing their capex by 300 billion this year, which is 1% of US GDP, and you get big multiplier effects. You got to build the data centers, there's a lot of construction workers, etc., etc. So I think there's a lot of things going on. It's and interestingly, you build data centers, you then got to build energy units next to them. The story, and of course, defense spending is going up because of the war. All this stuff creates great multipliers and helps kickstart the industrial cycle. So I think it's a lot of things going on. But yeah, sure, part of it is probably Trump. Yeah, amazingly.
Oh, you're right on. I think we also like industrials at the beginning of the year, probably for different reasons. But the performance-wise, the ETF has done very well. The sector has done well. Some of it, like you said, might be related to AI, but others, even without the AI driver, I think they are going through a re-rating of some sort.
Yeah, I mean,
Yeah.
I think you have to be careful because some of them are very expensive. But you're right; they've got a lot of momentum, a lot of earnings momentum, and they're in the middle of the theme. So people like them for that reason. But the other stuff I mentioned, railroads, all that stuff, none of that's terribly expensive. So
No.
that's kind of interesting as well because it should react well to this pickup in industrial sector.
Yeah. Well, value stock tend to do well in a cyclical upturn. That's great,
Yeah.
and I really appreciate the insight. And you've been also made a lot of good calls in the U.S. in the past. I know that's why we follow our research, we purchase our research, and we've been using it a lot. And then let me also switch gear a bit. I know there's a lot to talk about. We can probably talk another 2 hours on the U.S. But given that you're sitting in Europe, and a lot of our investors are interested in Europe after seeing the resilience in 2025. And don't forget, but the same time, we also have a war going on still. The Russia-Ukraine war has not ended. So maybe start with that, and whether that's still relevant, the whatever is happening between Russia and Ukraine, kind of like dragging on, and secondly, any other non-geopolitical factors in Europe that's catching your eyes right now.
Yeah, look, there's a lot going on. Let me just, sorry, I think I thought I'd done this. There we go. Yeah, there's a lot going on in Europe, of course, and you got to, in some ways, you got to disentangle the economics and the market behavior. I mean, in some ways, you haven't, but Europe is more vulnerable to a high oil price. That's definitely so.
I agree. Yes.
Yeah, and you can see it here. We've done some modeling. Yeah. Well, natural gas, but natural gas isn't really up like it was in 2022 on the Russian invasion. It is up, but nothing like that. But clearly, as you can see, it looks to us like the real income is going to contract if $100 oil sticks around for a bit. Whereas, as I said, in the US, you've got to get it up to 170, 200. So it's definitely more vulnerable economically. What I worry about most, though, is how the ECB reacts. Because you probably remember when they hiked rates in 2008 into the crisis. The oil price spiked to 150 in 2008. You remember when they hiked rates, and that was a huge mistake because, of course, we're in the middle of the global financial crisis, and they worry a lot more about second round effects than other central banks. They're very focused on this, and they've already made comments about it. So, if I look at the Eurozone economy before the war, I call it sort of stuttering. It had good momentum last year. Then they stopped cutting rates and it stuttered a bit and didn't quite get to sort of full escape momentum, if you like. And
that's kind of the central bank mistake you talked about earlier, right? That's kind of the risk. If a central bank kind of misexecutes this, it could accidentally stall the economy.
It's a big risk because it's already slightly stalling. So the last thing you want to do, if oil price goes up, people have less income, so they've got less spending power. And if you raise rates as well, you double down on that problem. So I think that's a real concern in Europe at the moment. Now, look, having said that, say the war disappears in a month, oil price comes down, therefore, Europe's more relaxed, the Fed cuts rates, and then the ECB it'll certainly won't hike. It might even think about cutting. So what the point there, though, is if you look at this, if you want to know about Europe, you've got to know about what are the banks going to outperform. If the banks outperform in Europe, the market tends to do quite well. And the banks will outperform if the yield curve steepens up. And the European yield curve follows the US one. So as long as the war goes away, Europe probably benefits from the Fed cutting rates, and it gets a bit of a steepening in there. And
it's good for banks.
It's good for banks. And I think we probably talked about Spain and Italy a year or two ago.
Last year you made a great call on that. The PIGS country, you talk about Italy, talk about re-leveraging the UK as well. But it looks like because of the central banks, the indecisive central bank in Europe, the trajectory might be off a bit. Am I right to assess that?
Yeah, the trajectory, it needs central banks to sort of ease off a bit and calm down and for the war to dissipate. Yeah, because I think that there's a real risk in Europe the trajectory gets hit harder than it is in the US. And you don't have that AI. And if you think about it, the global market's gone back to the AI trade. Yeah. So we're watching closely, but I mean, Spain and Italy still remain great picks. The mid caps have been terrific, as well as the large caps in Spain. I mean, and the great thing about Spain is most of its energy is natural gas, which it gets from all over the world, including North Africa. So its supply hasn't really been affected, and it has tons of alternative energy. So it's got a load of sunshine and a load of solar. So Spain is kind of isolated within Europe. It's linked to LATAM as much as it is to Europe. It does a lot of trade with LATAM. So I think that story is still there. I like that story, the Southern European story, Italy, Spain, even Greece. But I'm just cautious about the big ones and that Europe as a whole at the moment. It just makes me a little bit nervous. So we just need to get to a resolution or buy Europe on weakness if we get that in the next month or two, because it'll come back, but we've got to get beyond this hump, I think is the point.
And so overall, you're not positive on Europe, but you do like certain countries like Spain and Italy and
Yeah, and and the UK's got a few problems at the moment, unfortunately. It was looking good 12 months ago, but our government unfortunately hasn't really helped the situation. Quite the reverse. And now we have huge political problems in the UK. We might lose our prime minister any day in the next sort of week or two or three. So that is a concern because it feeds into the gilt market and the bond market, and makes it difficult, currency difficult. It makes it difficult for our economy to get going. Unfortunately, we're kind of at stall speed as well. So that did work. Large cap UK has worked because it's got a lot of energy in it, as well as banks, which were working. But just a little bit concerned near term about that as well.
Well, the political stability is important. I think if UK cannot secure that, that's not good for financial markets. I know we asked this. I asked you this before, and I'm going to ask you every time about you as a European analyst or UK analyst or foreign analyst, especially on the macro front, your view about China, but particularly about whether you're seeing more interest in China. Since we spoke last time, just for information, the Hong Kong market has done very well. The Europe did well, but Hong Kong also did extremely well because we have a lot of IPOs last year. This year, the market has been sideways, but we also have some smaller IPOs that did equally well. Does that ever attract any interest from Europe? Do you get a lot of questions on China these days?
Well, ironically, the discussion about China's really died down, I'd say, in the last few months.
Good.
It hasn't. People haven't expressed a lot of interest. I mean, we obviously keep writing about it and talking about it, but people aren't asking about it. And I think,
Is it
Trump's
because so much
created.
attention is in the Middle East, or do you think people worry about oil shock impact to China?
I think people are less worried about the oil shock impact to China. Everyone knows there's a lot of reserves being built up, and a lot of the electricity is coal and so on, and alternatives and things like that. So I think people are less worried about that. A lot of EVs, as you know, all that sort of stuff.
Yep.
But I think people see the fact there's been a lot of promise of stimulus over the last few years, and not much of it's come through, and the economy looks poor.
Yeah.
I was looking at household credit in China the other day, which is now
It fell off
contracting.
a cliff. Yeah.
Unbelievable. Retail sales fell off a cliff.
All-time low. Yes.
Yeah, and car sales contracting. So, there's a lot of signs that aren't good. Housing doesn't look to be fixed. President Xi doesn't seem to want to fix it. So people are kind of, and the stock market, 18 months back, September 2024, the market, there was talk of stimulus and liquidity, and the market surged, and it was great for 12 months, really through to last year, sort of end of last year. And as you say, it's not been so good about. And I hear about the IPOs. I'm pretty sure Hong Kong's did more IPOs than anywhere in the world last year, if I'm right, which is amazing.
Yes.
But no one's talking about it. No one is talking about it in Europe or in the US.
Yeah, that's what I thought kind of strange. Now it's really a big deal here. But back to IPOs, probably US this year going to outpace Hong Kong because we have some big companies coming out, SpaceX and OpenAI and maybe Anthropic, who knows?
Yeah, very exciting. And these are the sort of IPOs that eventually mark a top in a stock market. So I'm excited about the US market, but if you keep issuing a lot of IPOs like that, you suck a lot of purchasing power out of it. And of course they often go at very rich valuations. I was very intrigued. I'm not an expert on AI other than a macro guy, but I was very intrigued to see the story about OpenAI missing its revenue targets the last few months. Not getting that speed of acceleration. Now, people say that's because Anthropic's taken up the running and Google's doing better and all that sort of stuff. But I think that may be an interesting sign. And there's, there are the skeptics on AI are building. Michael Berry, you probably know they're always there. But you know, Michael Berry, the big short
Yeah, the
guy.
big short guy. Yes.
Yeah, you know, I think he's a classic analyst. They can be several years early, but have the right
Yeah.
point. Famously in the film, you see him drumming for hours because he's sort of 2 years too early on the trade. But I think you know,
Painful.
he's making some valid points. They're not relevant yet. You know, stock markets bubbles burst. I'm not saying it's a bubble, but it might become one. They
Oh,
burst when money gets tight. You know, and when that happens, then it'll be very good for the rest of the world's stock market. So I think these trends are really interesting to keep an eye on, and
yeah. Well,
monitor. And
yeah. We have big tech earnings this week. Actually, today and tomorrow, we're probably going to get verified, what you just said, whether this got this have valid concerns surrounding the return on investment for AI, whether there's an AI bubble, whether the hardware is just overpriced and all these things. I think it's definitely a big topic, given that, you said earlier that stock market in the US today plays a pretty big role in the economy, in consumption, in confidence, and almost everything.
Yes,
Yeah.
that's right. And I suspect they'll all be pretty good. And you see the benefit. I mean, Korea is the case in point, isn't it? With the
Yeah.
two stocks dominating the index. And I
And the
was hearing
currency went up too last year.
what's that? Sorry.
The Korean won went up too, along with the stock market.
Yes.
So you got a
Yeah.
double whammy. Yeah.
Double whammy. And these stocks, you know, they're good for now, and the market's very cheap in Korea. But one's got to be slightly aware that Samsung are making and have got extraordinary margins at the moment in what is normally a cyclical business,
Yeah.
and of course they dominate the stock market along with SK Hynix. So yeah. I think the trend is still there. AI momentum's still there. It's still an exciting place to be, and it's revitalized in the last month or two, and so it's probably going to have quite a lot of momentum. But at some point, we'll have to start wondering and worrying about that, and I just don't think it's yet.
Well, we kind of went around the world already. We talked about U.S., China, Europe. I can go on a few more questions, but uh, what is the most common question that you get these days? Like the ones I have not asked so far. I know the Fed is always a hot topic. The inflation is always a hot topic. AI, hot topic. Anything we're missing here today that you think is worth mentioning that I did not ask?
Well, I mean, the Western economies and the Western politics is obsessed with the affordability question, which we sort of half touched on, and the lower income scales and that sort of thing. That is a very big focus of people. You know, I mean, I think in terms of sort of interesting trades out there that no one's really thinking about, you know, Japan is interesting.
Yep.
We don't, you know, I do get asked about that, but again, it's a bit like China. It's not front and center at the moment, and a very attractive 30-year, 40-year bond yields there. And I don't believe that economy is long-term inflationary. It's got a shrinking population that's getting older. This is not an inflationary environment. So
Massive
Japan's an
deflationary
interesting
pressure. Yes.
exactly. You know, people occasionally we talk about carry trades. People talk a lot about Brazil and Mexico. They've got very good real interest rates. You can get good carry trades into those countries. People are quite getting into LATAM because, of course, Trump's got a lot of interest there. They've got a lot of commodities. I'm talking a lot about. I think gold and silver's done its best for a while, and people are switching from precious metals into industrial metals, so copper and aluminium, which all benefit from AI and that sort of stuff and electricity build out. So look, the subjects are endless. Ags, we haven't talked about ags. Probably not your thing, I don't know. But
interestingly, you're not the first person telling me about Latin America this week. I probably heard at least two other people talk about Brazil and the commodity trade and all the hot assets. And it seems to me that today the hot assets have become not only an investable, attractive financial asset, but also like a leverage among countries now. People are using this as leverage, kind of as the bargaining power, rare earth, copper,
yes.
aluminum,
Well,
agricultural products.
China set the way, didn't they? I mean, in their negotiations with the US last year, and very sensible use of rare earths to make their case and push back. So you're right. I mean, it's I think energy service companies are interesting as well. because, of course, we're probably in an energy uptrend. I mean, energy might give back, oil might come off 15, $20, $30, but it's probably in a long-term uptrend, and you need service providers. We've got to reopen all the wells in the Middle East at some point. I think once oil's at 80, everyone's going to be Shell's back on, Canada's back on, Venezuela's going to be. So that
Russia's
there's so
back
many
on
themes
already.
out there.
Yeah, Russia's sanction lifted.
Russia's sanctions partially lifted. Yes, exactly. Yeah. So there's a lot going on. It's kind of interesting. There's a lot of opportunities out there.
And I want to ask you to also give us an intro about yourself. For the folks that follow us, they probably know who you are and your firm, but please also take a few minutes to introduce. I apologize, I should introduce the firm in the beginning, but for the benefit of our readers, can you tell us about Longview, what services you offer, where you're based, what kind of research you do, and how people can get hold of your great services?
Absolutely, yeah. I mean, Longview Economics is a business I set up in 2003. So we've sort of been around nearly a quarter of a century, which is fantastic. We're a boutique based out of London. What we care about is really taking macro and valuation and technical patterns and risk appetite models, and we add it all together and come up with where do you invest in the world. And we kind of do that in different ways. If you're a short-term trader, we've got stuff that covers that. We do a piece every Monday that looks at things like trading treasuries, trading currencies, trading volatility, trading equities. And then if you're a long-term investor, we look at global asset allocation over 2 years. Where should you allocate money to? Like you said earlier, Europe last year was a pick of ours. Spain and Italy's been a pick for a while. And we kind of pick countries. Chile's a very interesting market because it's a play on copper. And we connect macro to individual stock markets and sectors in the global stock market. I think like Stan Druckenmiller said, 80% of a stock pick is macro. It's macro country, macro currency, macro sector, macro factors driving that sector, and then one company versus another. So all of that's very important. We do that, and we speak to professional investors all around the world. As I said, I was in New York. We go to Australia. We come and see you in Hong Kong and Singapore and so on, and across Europe and based out of London. And if people want to find our work, you can drop us a line at info@Longview Economics or research@longvieweconomics.com, or you can go on our website, longvieweconomics.com. Or if you want to just we produce eight different publications, but one of them we put on Substack. And if you look for Longview Economics on Substack, you can subscribe to that single one of those 8 publications. But we're thinking, as I said, we're thinking about markets short term and long term, and it's really macro based, and how you get along with models to investment and trading decisions. So it's a lot of fun. I came out of the city of London in the 1990s. I worked at a company called Cazenove, which used to have a Hong Kong office and a Singapore office. I think certainly a Thai office. It had quite a few offices in Asia. Now owned by JP Morgan. But I left there in 2003, set the business up because I love markets, and the team of the 6 of us love getting involved in markets. And I always say there's really only 3 or 4 things that matter in the global economy. If you can work out what the key questions are and what the answers are, most of the asset allocation and sector allocation comes out of that. So obviously at the moment, Iran is critical. But it's also this broadening of the US economy is critical. It's also the capex acceleration. It's also, how long AI extends for and things like that. So what the Fed does, what European central banks do, all that kind of stuff. So, yeah, that's kind of us. We enjoy working with you guys. It's been a lot of fun so far.
Yeah.
Looking forward to more.
We may not agree on every topic, but I personally find your research really helpful. I came from a stock picking bottom up background as a stock analyst, but having that macro perspective, have that top down view, I think it's incredibly important. My understanding, you also offer some technical analysis. Am I right?
That's right. We have a bunch of sort of risk appetite models that we've run for
Yeah.
20 plus years that
And
feed into that technical kind of approach. And we produce a
and
weekly rag which has some insights into the S&P basically and where it's going and that sort of stuff.
I think it's great. Okay, let's stop here. We got about 10, 15 minutes left. I do want to open the floor for questions while Chris is here. You can hear directly from horse's mouth. And Chris, you also will be in Asia. Make sure you tell us the dates and the location. We make sure to get people together to meet you and introduce you to some of our colleagues and clients. So with
That'd be
that, let me
great.
open the floor for Q&A. If you have any questions, please use the Q&A window to enter them, and Chris and I will try our best to answer. Have any questions, please use the window here to enter them. Chris, I'm not sure you can see the question here. Let me read it to you. So this is to you. Do you think U.S. market may crash going into the second half? As it is known that during midterm election, market normally very volatile.
Well, that second part of the statement is absolutely correct. If you look at the presidential cycle, year two on average is a zero sort of year. You get a lot of volatility. That's true. But we've had a lot of volatility already. I think, frankly, it all depends on what happens in the Straits of Hormuz. I don't think it. You don't normally get major sell-offs immediately before midterms. You do get volatility in the year of midterms. So I would be focused on the oil price and all that issue. You need someone to create that challenge. And actually, if you think about the politics, we all know the House of Representatives is going to be lost. Maybe if you lose the Senate, maybe that changes things a bit, but I think that's unlikely.
Yeah. Well, I do want to ask you a question about the news today that UAE exiting OPEC, because you talk a lot about oil price. You said, the Iranian situation could be resolved, but long term you're still bullish on oil price. What do you make out of this news about the change in OPEC members?
I think it's fascinating. I mean, the bulls out there are suggesting that OPEC has a lot of challenges and we shouldn't worry about it. They often lose members, but this is a key member. I mean, the UAE. There's two members with spare capacity, Saudi and UAE, and we know that they're sort of not keen on each other at the moment, and they've been fighting sort of in a proxy sense in Yemen. I think this is significant. It's particularly interesting to me that it happened after UAE got a swap line off the US, because the US has always wanted to break up the OPEC cartel. And I think maybe this is the tit for tat on the currency swap that, we'll lend you money, you need to leave OPEC. And this is great because, of course, the pipeline is there to the Fallujah refinery that bypasses the Straits of Hormuz. We know the UAE, they're producing about 3.5 million barrels per day. They could do 5 million pretty much off the bat. And I'm sure they could grow that quite meaningfully. So one of Trump's goals in the end, and this is when you get into what's really the grand strategy of Trump, one of his goals is to get the oil price much lower and control a lot of the world's oil. And I think it looks like he's just pulled the UAE into his orbit, basically. So I think it's pretty important. And I think long term, it says lower oil price once we get beyond this war. So it's a big moment.
Got it. Well, there's a question, another question on AI software sector about, I think, autonomous car software. Well, today we're going to focus on macro, so I couldn't really answer that question. Unless, Chris, you have any thoughts about, there's a company called Pony AI and We Ride. Any views? No? Okay.
Way beyond my pay grade.
Yes.
As we say. Yeah.
Well, you're already a very smart person. I think this is such a niche sector. I also personally don't have a view on that. Okay, let's move on to the next question. Anyone has any questions on macro, US, China, Europe, Middle East? Please use the Q&A window to enter the question. The next question is kind of what I asked you before, but maybe we didn't get a chance to talk in detail about the Ukraine-Russia situation. And then what do you think about the U.S. comment? Well, Trump kind of hinted at one point that they're going to withdraw from NATO. So maybe on the overall European geopolitical situation and how that may impact the U.S. the European defense sector.
Yeah, this is actually Trump has been great for Europe in that sense.
Oh, I
He's
agree.
he's
Yes.
he's
Yeah.
he's really
It's a
beaten up on the
wake-up call.
Europeans.
Yes, definitely.
Yeah, and they're waking up. Chancellor Merz of Germany has made some very strong comments about Europe needs to deregulate, Europe needs to free up its labor market. Europe's got a bigger, more people in Europe than the US. It's a bigger market. And Europe's created its own defense fund outside of the US. So I think Europe's finally got the message that the US is no longer going to look after them. So they've got to do it themselves. So it's good for spending in Europe. I actually think that's a real positive. And people, the thing about Europe is, I know everyone always beats up on Europe. It's got a lot of problems. I accept that. But also, if you look at the venture capital space in Europe, it's been growing very fast. It's just 20 years behind America. And there's more PhDs in Europe than there is in any other region of the world. So there's loads of potential and it's coming. It's just behind. And if Trump pushes Europe even further and they deregulate and get their act together, then it could be a bit better. So in terms of Ukraine, look, we had the election in Hungary. I don't know if you got that in your media or not. A couple of weekends ago, Viktor Orban's out. He was blocking the funds from Europe to Ukraine, so he's now gone. So those funds are going to go, and that'll support Ukraine in their fight against Russia. But yeah, I mean, it's kind of ongoing. It's almost sort of state of stasis, if you like. It's kind of there's no developments one way or t'other. It's just they're stuck in this war, and I think it's going to be up to the Europeans to try and get them out of it. And they need more of a defense industry to do that. So these stocks, they're not cheap, but they've got good momentum.
Oh, they gone up a lot the last
They've gone
couple
up
of
a
years.
heck of a lot, yeah.
And let me be clear, whether this Ukraine-Russia thing ends or not, whether if and when this will end, and whether Trump wants to really withdraw from NATO, this is a one-way street, right? So it's not like the Europeans are going to be like, well, if Trump promised to stay, then we're going to reverse our spending. Either way, they're going to ramp up their defense spending and trying to be more self-reliant. Am I right to say that? This is kind
I
of a
think
secular trend. It's not so much of a short-term kind of a fad kind of thing.
the penny has dropped,
I see.
and particularly in the last 12 months, it's well and truly dropped. So this is not going to reverse this trend. The only question is whether or not Europe can make its economies good enough to deliver the money to make it all happen. But certainly, I think it's very doable. And if you get people like Chancellor Merz in charge enough, it's not difficult. You just need to get the welfare bill down, and then the economy will grow, and you'll get more money, government revenues, in order to spend on defence. So totally doable. Just needs a will. So yeah, it's a secular trend. It's not a one-off fad. It's a new world order, basically.
That's why they're seeing the same thing. And then maybe we can tie this back into how UAE want to leave OPEC. Kind of now we are seeing every country for itself. So maybe Europe is also entering a regime as Europe for itself.
Yeah,
That they can
it
no
really
longer
seems to
rely
be.
on Russia for energy completely or rely on US for security.
Exactly. And they've already weaned themselves off most of the Russian energy. There's hardly any of that coming through, little bits and pieces, but nothing much. And yeah, and they've created a European defense fund by Europe only. So those trends are happening. They're underway. They're European Commission, European Union mandated. They're long-term trends. And there's going to be lots of spin-off consequences.
And when you say that they need to have to raise capital or financial to do this, are you also referring back to this ECB risk again? Like that for all of this to happen, for a true European revival, the central bank need to act accordingly as well to accommodate these changes.
Yeah, you need a central bank that is savvy, I think, politically savvy. Yeah. That's
Well,
kind of, I
definitely
think
more
that's the
savvy
key.
it is then. Yeah. Well, the US is
Yeah.
very good at this, these kind of industrial, financial, regulatory collaborations. But Europe seems to me just a bit uncoordinated, I would say,
It's
sometimes.
harder, yeah. It's certainly harder because you've got 27 voices, really, too many countries, and they all have their way of thinking about life. So,
Yeah.
and actually, when France and Germany aren't aligned, when they're aligned, that helps. But they're sort of structurally kind of different kind of thinkers, France and Germany. Germany's hard money, fiscal rectitude. France is the opposite. So, but yeah, it'll be interesting what happens in the French election next year. When Macron has to leave, how French politics ends up looking, because we kind of know about German at the moment, and you probably need a bit of French on that sort of the same sort of page. But yeah, it's
Yes.
harder in Europe. You're right.
Okay, one last question, and this is perfect for you, Chris, is asking about the British Central Bank, Bank of England, will it raise interest rate tomorrow? If so, by how much? And maybe just comment generally about so we didn't talk about UK, we talk a lot about Europe. Like what is going on with the UK and the monetary policy and
Yeah,
economy
yeah.
wise?
Well, the UK should be having a good economic recovery now, but our new government that's been in power for 2 years now has basically killed it off, so that we're sort of stagnating. And now our central bank is a little bit worried about second round effects. So I don't think they'll respond to them. Our labor market's weak. We're losing jobs. Our unemployment rate's going up. Wage inflation is falling sharply. So there's no reason that they should raise rates other than the oil price has gone up. But
Well,
but there's some of them on the committee are talking about these second round effects. I'm just
yeah.
hopeful that the mass of the committee doesn't respond to it. So they won't do anything tomorrow. They'll talk about two-way risks, probably like the Fed. I think what matters is what they do the meeting after that and the one after that, and what comments we get out of. But the reality is that the market's already got 2.5 hikes in it in the futures curve for interest rates. So,
Interesting.
if I was a betting man, I'd bet on some of those coming out. That would be a good trade, I think. The same story in Canada, actually, in many parts of the world. There's too many hikes. There's no house price inflation in the UK. House prices are contracting in Canada. So yeah, I think we have a bit of a political challenge in the UK, and we've also hopefully got a central bank that's going to hold its nerve and not get carried away. So
Great. That's a great answer.
Blighty
Yeah.
is struggling.
Well, let's keep watching that. And with that, let's end the call today. Thank you, Chris, for joining us. That was a really great conversation I've had for a long time. Also, thank you for joining this call and lots of good questions from the audience. If you want to learn more about Longview Economics, please go to their website. Also, the replay of this call today will be available on our UOB Hian Wealth Vision YouTube channel if you want to dive into it. Thanks again, everyone. Have a good night
Thank
or
you.
day in the UK. Thank you,
Yeah,
Chris.
thanks very much.
See
Appreciate
you
it. Great
soon.
to chat. Thank
Yep.
you. Bye bye.